Hello. I'm David McGard. This is Property Value. We talk about commercial real estate focused on South Florida. And today we're going to talk about multifamily, everyone's favorite, rent surging, people buying in the Sun Belt, people migrating, filling up vacancies below national levels. So let's show some of this. Let's see where it's come from. Let's see where it's goes. So this is the headline news in CoStar. It states rent surge in these often overlooked southeastern cities, which we call the Sun Belt. Sun Belt migration flowing to smaller and mid-sized locales. This is by Chuck McShane and David Kahn, CoStar Analytics. And today is March 25th, 2022. Welcome. As populations continue to shift to the Sun Belt, multifamily markets in southeastern cities have seen historically fast rent growth. This is what we've all been talking about for the last 12 months. While the growth of the large metro areas is well documented, strong net migration is pushing apartment rents up in many smaller or mid-sized cities across the Sun Belt. That's because the competition in these metros is getting too strong. So what's happening? People are getting creative. Investors are getting creative, developers are getting creative, and they're sprawling to these other small cities around the metros that aren't too far to drive. Across the United States, the top 10 metro areas for rent growth with between 10,000 and 50,000 apartment units averaged a 23.1 annual increase. That was in rent year over year, while the top 10 markets with 50,000 or more units were up 21%. So pretty close year over year. The difference in rent growth at the extreme is even greater. The fastest growing mid-sized city, Naples, Florida, West Coast, Florida, beautiful beaches. People used to think about retirement, not anymore. Growth at the extreme is even greater. Okay, so Naples, Florida saw 38.4% rent growth, while in the fastest growing metro area with more than 50,000 units, Palm Beach, Florida, rents grew by 26%. That's on the east coast of South Florida. So basically, two South Florida cities growing at crazy, robust amounts. Here's your side. Here's your chart. Rents rise in mid-sized South Florida apartment rents. Let's look at the Florida ones, since I'm in South Florida, and that's what we're focused on. Naples, number 1. Sarasota, number 2. Fort Myers, number 3. 1, 2, and 3 in Florida. Then we skip down. We got Lakeland, Florida. We hit Melbourne, Florida. Daytona, go to the East Coast. Pensacola up in the Panhandle. And that's all for Florida. So it seems like Florida cities dominate the top 10 areas for rent growth across all size categories among mid-sized markets. Sarasota, that's on the West Coast, with 33% growth. In Fort Myers, West Coast, 30% round out the top 3. In Lakeland's 18%, ranking 6th. In Melbourne, 17%. And Daytona's Beach is 17%. That's 17% rent growth year over year. That is outstanding. Daytona came in ranking 9th, or Melbourne was 9th, and Daytona was 10th, respectively. Other coastal markets, such as Savannah, Georgia, with 20% growth, Wilmington, North Carolina, 18% growth, Myrtle Beach, South Carolina, 18%, ranked 4th through 6th, and the Appalachian tourism destination, Asheville, North Carolina, with 17%, ranked 8th. Builders are looking to capitalize on the strong rent growth observed in many of these smaller metro areas and are busy breaking ground on new projects to meet recent demand. Small towns and rural areas have increased their share of new apartment permitting over the past 2 years. According to the National Association of Home Builders, places such as Myrtle Beach, Naples, Fort Myers, and Lakeland rank as some of the most supply-heavy, mid-sized metro areas in terms of supply underway and net completions as a percentage of inventory. But the increase in supply could take years to meet the newfound demand. And each of these fast-growing cities rank highly for both apartment demand and rent growth. Remote work trends, acceleration of retirements, and tight single-family for sale inventories have increased the appetite for renting in smaller markets with limited existing supply. Home ownership rates in Florida, for example, trend higher than in other southern eastern states, which has limited new supply relative to population growth. Nearly 77% of Sarasota households live in owner occupied housing units as of 2019. That lack of earlier investment has put extreme pressure on existing multifamily rental supply, with stabilized vacancy rates, which amount only for properties 18 months or older at around 3%. In Savannah, by contrast, where the homeownership rate is 60%, the stabilized vacancy rate is just above 5%. Demand has increased in some mid-sized markets because of the affordability advantage compared to nearby larger metro areas. In North Carolina, Greensboro and Winston-Salem, which rank 11th and 13th among mid-sized markets for rent growth at 16% and 15%, retain average rents less than $1,100 per month. That offers a substantial discount from the larger nearby Durham and Raleigh areas where rents average around $1,450 per month. Rents in Lakeland, Florida, which is inland between Tampa and Orlando, areas average $1,400 per month, which is nearly $300 per month discount from both larger neighborhoods that bracket that submarket. On the other hand, some amenity-rich markets don't necessarily offer a discount from larger cities. Rents in Sarasota, for example, average $1,900 per month, more than $200 per month than the nearby Tampa. In North Carolina, Asheville's average rent of $1,500 per month is slightly higher from the largest in the state of Charlotte, where rents average $14. College towns such as Knoxville, Tennessee, with a 16%, and Boulder, Colorado, with 13%, also rank within the top 20 of the mid-sized markets. It's incredible what's going on out there. But so that's what we're seeing for, rent surging in these not metro areas, but a submarket close to the metro area. And then, so let's see what's going on. I've got my next article actually says here, check this out. This is by CoStar again. Here's why apartment rents in the Sun Belt are rising so fast. So this is cool. The last one was telling you about the facts. This is telling you the why. So this is also by David Cohen and Chuck McShane, CoStar Analytics. Demand for apartments has hit record levels across the United States. So the last article we were talking about just about the Sun Belt and the mid-sized markets, but this says across the whole United States, lending to unprecedented rent growth since the start of 2021. Rent growth has been even more pronounced in some large Sun Belt cities where rents have been well below the national index for quite some time, but are now close to above or the national average. So why? Why were they below the average and why are they have increased now? It says the run-up in rents is being driven by exceptionally strong demand, which has outpaced net deliveries in most markets across the country, driving vacancies to historic lows. So since the high demand, these vacancies are going low. And when the vacancy goes low, what happens? People build. New household formation has pushed the U.S. multifamily vacancy rate to 4.9%, which is well below the 20-year historical average of 6.8%. Overall, apartment vacancies in Sunbelt cities are traditionally higher than the national average, as most cities across the region lack that type of land constraints and zoning regulations that prevent large-scale new supply in the East and the West Coast gateway markets. But the pandemic and the surge in apartment demand felt across the Sun Belt have driven vacancies below historical norms in every large southern metro area. Among a selection of Sun Belt cities with more than 50,000 apartment units, overall vacancy rates are now lower than the 20-year historical average in all 20 metro areas. Bring this up a little bit bigger. Check out this chart. This is Memphis to Miami. The blue indicates where current vacancy is, and the orange line up here indicates where historically it's been. There's a big delta in between every one of these metros of historical vacancy and newfound vacancy because of the higher demand in these areas. So let's get back to this Major Sunbelt markets such as Dallas, Fort Worth, and Atlanta are historically at 8.5 vacancy markets. 8.5 vacancy markets. I can tell you, as being a commercial real estate appraiser myself, who's dealing with multifamily and developments every day, I've never put a stabilized vacancy at 8.5. It's always been 5%. Now it's 6%, maybe 5%, maybe for some um, loss to credit or something, but it's 8.5 vacancy markets. I've never modeled ever in my career that high of vacancy. But both of those metro areas boast vacancy rates around 6% now. It's a similar story in South Florida, where vacancy rates are below 4%. Well, that makes sense, right? I live in South Florida. I underwrite commercial deals in South Florida. Why would I ever put 8.5% when the facts show right here, South Florida, where vacancy rates below 4% in both Miami and Fort Lauderdale are far below historical norms. And those are my areas that I work. That's where my specialty lays. Vacancy rates are closest to the historical norms in markets where new supply expansions have been the largest. Fast-growing mid-sized cities such as Charlotte, North Carolina, Nashville, Tennessee, and Austin, Texas have all seen their multifamily inventories expand by more than 4% over the past 12 months, compared to 1.7 inventory expansion nationwide in 2021. So it's more than doubled the nationwide expansion. In the smaller Charleston, South Carolina market, that growth was even more dramatic, resulting in a 6% inventory expansion. Regardless, vacancy rates remain below historical average. Here's another chart showing those averages. There's the delta. Look at Nashville. Jesus. Under construction as a percentage. Oh, sorry. The blue is the 12-month delivered as a percentage of inventory, and the orange is an indication of under construction as a percentage of inventory. Back to the article. Looking forward, cities with the most properties under construction as a percentage of inventory are likely to see their vacancy rates rise closer to or above the respective historical average in the near term. That's mere supply and demand. More than 10% of current apartment inventory is under construction in Austin, Nashville, and Miami, in places such as Charlotte, Orlando, Phoenix, Raleigh, and Fort Lauderdale are not far behind at 8 to 9%. Even if recent demand trends persist, this amount of supply will lead to rising vacancies and more modest rent growth in the coming quarters in these metro areas. Larger markets such as Dallas, Fort Worth, Houston, and Atlanta have more moderate supply pipelines as a percentage of the inventory, but all three rank among the top of the country in terms of units underway. Among smaller cities, Charlotte's growth is an outlier. Construction activity has yet to ramp up in such cities as Memphis, Tennessee, North Fork, Virginia, and Birmingham, Alabama, all of which have a modest of 2% of inventory underway. So the top markets have 10%, not far behind 8 to 9. Down here, Memphis, Tennessee, North Fork, Virginia, and Birmingham, Alabama at 2%. I wouldn't be surprised if you see more development in those three locations. All right. So we've read something about rent growth in mid-size Sunbelt cities. We've read why it's this growth, because the historical vacancy levels are so much lower than where they've been in the past 20 years. And now developers can develop. Rent growth will, level out. Vacancy should increase a little bit, where the inventory is, 10% of where the under construction is 10% of the inventory. Those are the higher cities of development. So now let's go granular and look right at Miami. So my last article is from the South Florida Business Journal. Brian Bandel, senior reporter, South Florida Business Journal. He writes, where's the title? 800 plus apartments could break ground near Aventura Mall future Brightline Station. If you don't know the Brightline Station, that is the private train line that's going from Miami. It will end up in Orlando, but right now it has stops in Fort Lauderdale, high-speed private train line, stops in Fort Lauderdale, stops in Palm Beach, West Palm Beach, Florida. And the developers are developing beside it. It's called transmodal development. And here is an example of that. So Mill Creek Residential has proposed a 15-story apartment complex just west of the Aventura Mall near a future Brightline passenger rail. The Boca Raton-based developer filed a pre-application with Miami-Dade County for the 4.85-acre site. Mill Creek Residential has it under contract with Miami-based, and it's managed by Bruno Blocks in Miami. The site currently has an 18,000 square foot warehouse that'll be demoed for the development in the near future. It's located in the Ajou neighborhood west of Aventura. There's been more development in this neighborhood in recent years because of the changes in the area's zoning by the county that will allow for a mixed-use development. Plus, it's near Aventura Mall, the largest mall in South Florida. This particular site is 2 blocks south where a Brightline station is under construction, so residents could use the train to reach Miami, Fort Lauderdale, and West Palm, with stations in Boca Raton and Orlando coming soon, and maybe Stewart, Fort Pierce, they don't know yet. Madura, Aventura, would have 184 apartment units, 15,000 square feet of retail facing West Dixie Highway, and 1,000 parking spaces for its tenants. It would be developed in 2 phases of equal size. The 2 buildings would have separate pools. Coral Gables-based Corwell Architects designed the project. Miami-based attorney Nicole Wolf, who represents the developer in the application, couldn't be reached for a comment. But Mill Creek Residential has completed or acquired more than 43,000 apartments in 160 communities for more than $12.7 billion invested. It currently has more than $9 billion in assets under management, including 119 apartment communities with combined 32,500 units. It seems like they know what they're doing. So, 800 plus apartments. We talked about rent increases. We talked about vacancy decreases. And here is a story about really putting all that into play, building it beside one of the largest mall in South Florida, building it beside the train, so for transportation, and taking advantage of these low vacancy rates in Miami-Dade, sub 4%. Robust 2022 continues. This train has not stopped yet. I'm David McGard. This has been Property Value. Talk to you next week. Have a great weekend. Bye-bye.